Welcome in, everybody, to the Investing in Real Estate show. This is our live edition where we're going to talk about the state of the market. And there are some troubling signs in the economy, but I want to couch this because we're going to look at what happened in 2008 and we're going to compare it to where we are right now. I get this question from so many people that say, hey, is this like 2007, 2008 all over again, the housing collapse? And there's a number of big differences, 5 big differences that we're going to go through what's happening right now. But before I get to those 5 things, I just want to talk about some of the status markers that are in the marketplace right now. And among those things is the US dollar. So the US dollar over the past few months, people will tell anybody who would listen, hey, the US dollar is strong. Look how strong it is. So all these people, all of these all these people who were jumping out of the stock market like crazy. I mean, you have companies like Nvidia down, 60%, Meta/Facebook down 70%. All of these people jumping out of stocks right now because of the volatility. And where are they going? Well, they're going into real estate, they're going into precious metals, and they were going into the US dollar. US treasuries, right, is seen as a safe harbor. However, that safe harbor is now evaporating. So a number of key signs on the US dollar on Friday that should give us all pause. We knew it was only temporary. When the central banks stop printing money or they pull back on the amount of money that they're funneling to Wall Street, then suddenly the US dollar is not as attractive. And now when we see that the US government, $31 trillion in debt, how are they going to pay this off? Likely not going to happen, according to Peter Schiff, that the US Treasury will literally be just taking in tax dollars and paying interest on the debt. That's what's coming for the United States government unless they have some major correction in policy. I don't see it happening anytime soon. And what you need to understand about the US dollar as a safe haven is that rally is now over. All you need to do is read Zero Hedge on Friday to see now this dollar index reversing, and you're seeing real concerns that is not the safe haven that it once was for people. And I've never believed, of course, the US dollar was a safe haven, maybe a temporary place to put your money in some treasuries while you're trying to figure out what else to do. But every time you're investing in the US dollar, you're losing money. If you're sitting there, and especially if you're in cash, like if you've got cash in the bank, in a 401k, or in a savings account. So if your US dollars are in US dollars and they're in a bank account, a savings account, et cetera, you're losing money every day because it just cannot keep up with inflation. So we see that as one marker, the US dollar. We also see higher inflation is coming, and the US dollar indicator is pushing us in that direction. We're going to see higher inflation in the United States, right around in the middle 8.2% range. You see Europe upwards of 20% in some countries right now. So just see where things are coming. What's going to happen to the United States spending power very, very soon. We're seeing companies raising all sorts of fees and costs. Netflix raising its prices, Disney Plus raising its prices, YouTube Premium raising its prices. Today, Apple announced it's raising its prices for subscriptions. So again, the dollar is not going as far. Companies raising prices just to keep up with their profits, and they will do well. These companies will be profitable because inflation helps big businesses because they will just line their pockets. They will think creatively about how to raise their prices. They will give you less detergent in a bottle. They'll give it like that shape, where the bottle, it's like a grippable bottle. That's what they'll call it, right? Now our new detergent is in a new grippable bottle. Oh, really? So what you just did was you just shaved out all of that extra detergent in the bottle, and charge us the same price. But it's grippable. Now you can hold the bottle better when you're pouring it into the laundry. It's ridiculous. And we've seen this in family size packaging, etc. The amount in the family size packaging has declined, but the prices have either stayed the same or gone up. Diesel prices, we're going to cover that on the show tonight. Diesel prices, we have about 23 and a half days left of diesel supply. That comes from the White House, although they won't want to talk about it. So some really troubling signs in the U.S. economy right now ahead of the election. And what are these politicians doing to help it, to stem the tide? It's all artificial. It's man-made. It's man-made and created. They're not doing anything. In fact, they're doubling down and going to send an additional $50 billion to Ukraine. That's what Republicans are gearing up to do right now before the election. $50 billion more to Ukraine because they need it, but you don't. So this is what our politicians are doing right now. They're playing chicken with our economy and America's future, and you need to be able to protect yourselves. So when we look at these signs, 2008, of course, we remember what happened. No one went to jail in 2008. In the United States, no one went to jail. No banks went to jail for playing this kind of fraud that they played with mortgage-backed securities, forcing people into these loans, telling them that it doesn't matter if you have a job, you can just take a mortgage. It doesn't matter. It doesn't matter if you even have a driver's license. You can have a mortgage. So a lot of things different from 2008 to right now, and why I'm still incredibly bullish on real estate investing as a safe haven asset right now. To me, it's all about preservation of wealth. We're in this crazy time right now. Cash flowing real estate, yes, you're going to get some cash flow, maybe not as much as you would like in a down economy. But to me, all I care about is wealth preservation at this point. Okay. So the cash flow, a little bit of cash flow, nice, great. That's not why I'm investing in these safe haven assets right now, real estate. Now, when things are great, then the cash flow explodes. But right now, it's about protecting our assets and making sure our family is protected with assets that are a hedge against inflation. And nothing, we talk about gold and silver on this show as well. Great, absolutely great. I believe in them. However, you do not get the tax benefits that you get from real estate investing. So if you have these safe haven assets and you have the capital to do it, and you have the wherewithal, the credit score, et cetera, to be able to do it, it's a no-brainer. Where else can you get financing where you put down 20% and you get a full asset plus the tax benefits of it? You don't get that with gold and silver, precious metals. Again, I love those asset classes, but there are, gold and silver and real estate for 4,000 years have sustained. You think it's going to change suddenly? I don't. So let's go into it. So 2008, what was different? Overall, today's housing market is much better and in a much healthier situation. So if we look at number one on this list, really in a much better situation than it was in 2007, 2008. Why? Well, banks learned their lesson in 2008 and they prepared their loans with a fine-tooth comb. It's much more difficult. Now, of course, there were a number of laws that forced them to do this, and we have seen some relaxing of this over the past year to 2 years, but that has again tightened. And now it's harder to get a loan, maybe arguably than ever before. So the people that didn't have a job, the people that couldn't pay back a loan, they've been weeded out of this process. So no longer are you able to get a loan like that. If you don't have a job, you don't have income, or you don't even have enough stated income for 2 years, you can't, that's just not going to happen. So just on the fundamental level, a lot of people saying, well, we're going to see a wave of foreclosures. I don't believe that to be the case. Now, I do think we're going to see a wave of layoffs, but will that lead to a wave of foreclosures? It's hard to say, right? We won't know until we get there, which could be the beginning of next year. But people who just simply overbought or overextended themselves, we're in a different era. And banks, frankly, aren't letting you do that. Overextending yourself. Oh, you're 75% of your take-home pay is going to pay a mortgage? It's not going to fly. Right? What is your take-home pay? What is your income? What is your debt-to-income ratio? And based on those things, we will give you a loan or we won't give you a loan. So a lot of differences here between on the mortgage front from 2007, 2008 to right now. Another big issue, number 2 on my list, is equity. Equity has skyrocketed due to the increase in property prices over the past 2 years. Now, that's great. Like if some people were, selling their properties at the height, they had them for a number of years and they sold them. They made some profits. Good for them. Some investors are seeing a 20 to 34% increase right now in their tappable home equity. What do I mean by that? That means the equity is money at their disposal right now. Borrow against the home equity or implement a cash out refinance. Totally different. than what we saw in 2007, 2008, where we saw a massive drop in home values. So I know a lot of people that, they couldn't really afford it, or they upgraded and they bought a house. And let's say they bought it for like $250,000. And it was the nicest house on the block. Well, then suddenly the market collapses and that house is now worth $180,000. Well, guess what? Their mortgage is still $250,000 plus interest, right? And mostly they're just paying those mortgage interest prices. So totally different experience. And so now we actually have that equity buffer. Now, are some of those home values declining a little bit? A little. And our home prices dropping a little bit? A little, yes. And we may see that going further down here as we head into the winter. Obviously, it's very difficult to sell a home during Christmas time. People don't want to move, so we could see some of those prices continue down. We'll keep our eye on it. But we still have a huge buffer, 20 to 34% increases in prices. Could we see a 20 to 34% decline in prices and value? Anything's possible. I don't think it is. We still have an incredible demand for houses. An incredible demand. We need about 6 million homes right now. Build from the ground up homes in the United States for housing. We don't have them, which means there's still an incredible demand for housing. We have a housing crisis in the United States. So a lot different than 2007, 2008, because many of those builders in 2007, 2008 overbuilt on the speculation, right? We can build anything and we can sell anything because anyone can get a mortgage. So all of these builders in Miami and Tampa, New York City and Vegas and Phoenix, they just overbuilt. California and all these homes just sitting there vacant, collecting dust, breaking down, ants eating through garage doors. So a lot of differences between the types of houses, the prices, and the market conditions from 2007 to 2008. So again, a lot of it built in equity for people that they can do other things with right now. So they have that extra equity position, whether it's even getting a home equity line of credit to then take that money out and invest in something safe, additional real estate or something else. Or just to have that equity position to know that they're safe for now, right? That they've got that cushion, they've got that padding while this market over the next year or so does what it's going to do. Elon Musk thinks we are in a recession right now. Peter Schiff thinks we are in a recession right now. Goldman Sachs' forecast for recession is 100%. They believe we are hitting a recession with a 100% certainty. Again, we need to protect our money. We need to protect our family's finances. Again, real estate to me is the number one way to do that. Nothing else provides the tax benefits of that. Number 3, negative equity. So when we look at 2008 and 2020 or 2022, what year are we in? 2022. Negative equity is virtually non-existent today, unlike how it was in 2008. So negative equity refers to a homeowner owing more on their mortgage than the property is worth. This was devastating, especially if you lost your job. What are you going to do? I'm underwater. I can't afford it. What am I going to do? Try to find a job so I can try to dig out of this hole? And banks were somewhat working with people and somewhat weren't, and then they suddenly would foreclose on you. These departments at these banks were not set up to handle this. They had to set up entire foreclosure divisions in these banks because they just didn't know what they were doing. They didn't see it coming. They didn't have a plan for it. Call up Chase Bank and literally one half of the bank didn't know what the other half was doing. The same with Bank of America. It was a disaster. Totally different than today. So we have this increase in property prices, and the negative equity catastrophe of 2008 has been, is not happening today, fortunately. Number 4 on my list, homeowners and investors have a much firmer footing with regard to their credit. Now, this came as a fail-safe with the rigorous bank loans. On average in 2008, most borrowers were leveraging with a credit score of around 640. And in 2020 to present, it's landing borrowers well above a 700 average in order for them to get a bank loan. So they're not dropping as down in that risky category anymore, 620, 640. Really, it's moving up. Average borrowers now around 700. So they have a much firmer footing on their credit. They've managed to pay down a lot of debt on their credit cards. And consumers, frankly, just aren't, right now at least, consumers just aren't buying a lot of stuff, which is why you're seeing concern among retailers who are saying they're going to have to lay people off because people aren't coming into their stores. See how all of this works, right? So people are carrying less debt. They've paid down their debt while we were in this pandemic. They didn't have as many expenses. They weren't traveling as much. They weren't taking that summer vacation. So instead of the few $1,000s they'd spend on that summer vacation, they were paying down debt or, frankly, improving their home or investing it. Number 5 on my list, one of the biggest differences from 2008 to now is the amount of ARMs, the adjustable rate mortgages that are currently on record. So this is, to me, this might even be the biggest one of all. According to CNBC data, the amount of adjustable rate mortgages on record today is about 2.5 million, as compared to 2007 that had 13 million. Think about that. In 2007, these adjustable rate mortgages caused about 10 million mortgages to potentially default as the rates reset. So your house thought it was worth this, the rate resets, boom, pops up, your house value goes down. You also, by the way, don't have a job now because the economy just tanked and because the housing market fell and collapsed. So what am I going to do? Now I'm going to be foreclosing. So adjustable rate mortgages, really not, it's very, not in vogue the way that it used to be. And of course, a lot of those adjustable rate mortgages that were sort of invented at that time came due for a reset right around the 2007-2008. That's what happened. So a lot of differences here between 2007 and 2008 and today. People ask, well, are we in a housing bubble? Are we seeing bubble territory? And my answer is always the same, which is there is no such thing as one bubble. Now, you might have different pockets, different parts of the country that are going to have problems. Again, that's why I don't invest in parts of the country where you have one job available, one oil refinery, or one Amazon distribution center, or one headquarters for one company. Because what happens when that company has to lay people off? Then rents collapse, right? Real estate collapses in that area. People leave. Jobs leave. Crime goes up. Tax basis drops. And that's when you have a recession in those particular areas. And so there is no one economy for housing. But just remember that we need housing in the United States more than ever before. And there are areas, of course, that are really smart investments. I mean, like what we're doing at Morris Invest within our West Texas market, right? We are able to provide a minimum internal rate of return of 18% right now. Minimum internal rate of return of 18%. But forgetting the cash flow piece of this, like just as a hedge against inflation and a protection for your money, again, it's incredibly important. So I want to play just a little bit here of what some of our recent clients at Morris Invest have experienced and what they've been doing recently, and just kind of give a sense of what they've experienced investing kind of during these turbulent times and making sure that they've got their money in a safer asset. So take a listen to this. Well, I understand we couldn't have audio on that one now. Oh, well. Anyway, I'll just tell you that a lot of people, so what I found interesting about this tape, and I'm sorry again with these audio issues today, I apologize, but what's interesting about that tape is that for a variety of reasons, like okay, we're worried about our family's future. We're worried about commuting back to, hours on the road every day and not able to take that money and invest it elsewhere. We want to be able to travel. We want protection against what's coming in this economy, a variety of reasons. So whatever the reason you have, it's time to start really thinking about real estate investing as a safe harbor asset right now. And again, cash flow, nice. Yes, of course. And during booming economies and better times, you're going to see greater cash flow, right? Higher rents, that you're going to see that. Right now, you're going to still have cash flow, but you're not going to be swimming in it like you might in a better economy. But the bottom line is you're going to still have it a hedge against inflation, and you're going to get all the tax benefits of with these write-offs on your taxes to offset your other income. You cannot even compare this to the stock market. Not even close. Stock market can't hold a torch to what real estate investing can do for you. Especially, and just look at the tax code alone. Once you read the tax code, you understand there is no better asset class than real estate to take advantage of the tax code. Watch my recent interview I did with tax genius Tom Wheelwright, where we dive deeply into the benefits and the changes in the most recent round of tax legislation. And he says, there's no better asset. Owning a business is great. One of the great ones, right? Owning a business. Real estate sits even higher than that. And a business that owns real estate, boom. That's like, use the McDonald's analogy, right? From Rich Dad, Poor Dad, right? McDonald's is not a real estate or not a hamburger company. It's a real estate company. Buying the best real estate on the best corners and charging rent for those properties, right? And the cash flow that comes from that business owning real estate in the most appreciating, developing areas. That's what we do. So if you're interested in booking a call with our team, we'd love to have you. We're taking calls, and we've opened up some calendar spots right now. We have a few spots available. We were booked up through November for phone calls. But we did open up an additional calendar just to accommodate those of you who are watching today. So if you'd like to book a call with our team, you can. Just go to morrisinvest.com and click on the book a call button there on the page. And a little calendar will pop up, and just put in your name, your email address, and your phone number so that we will call you at the time that you select. So make sure you put in the right phone number. Make sure you put in the right email address, because you also have a little bit of homework too. So we're going to send you a couple of PDF downloads to prepare for the phone call. And it's just going to ask you to kind of go over your basic finances and what do you do, like for you to, first of all, understand what you're dealing with financially. And then for us to kind of dive in and really be able to work with you. Talk about a self-directed IRA, or maybe you've got a 401k that's been sitting there not doing anything. What sort of bank financing is available right now? Do you have a home equity line of credit? All of those things we'll talk about on the phone and really custom build something for you. That's what our team does, and there's no one in the business doing what our team does. So please do that. Go to morrisinvest.com and click on that book a call button, and we'd love to talk with you on the phone. And make sure you're subscribed to the channel. We have tons of great content here. I would encourage you to all check out our masterclass series. If you're new to real estate investing or you're new to this way of thinking, we have a whole playlist. Go to our playlist section here on the channel and click that and watch that and start from zero. I have a close friend of mine who is he's a really, really smart guy, doesn't do any investing. And he said, where do I start? Last week he texted me and he said, Clayton, where do I start with real estate investing? He runs a business and he's super busy. And I said, I sent him the masterclass playlist. I said, start here, and then we'll talk, and then we'll go from there. So that's really, I think, a great place for you to start with that masterclass playlist. So anyone here, any questions here? Tim says, hoping to close on our duplex here in the next 2 weeks in Texas. That's great. And there's the Tom Wheelwright interview. SB Olive says another big difference between 2008 and now is Bitcoin. That's true. Absolutely. The case, 8 years now? No, 12 years of Bitcoin. What was Bitcoin? 2007, right? Or 2000? I always forget the year. When was Bitcoin invented? That's great. Awesome. Well, thank you guys so much for joining us on this Tuesday edition. Sorry for the couple of the audio issues we had a little bit earlier, but we'd love to jump on the phone with you and help you out in any way we can. So head on over to morrisinvest.com, click on that book a call button, and we would love to talk with you. Again, drop any comments and questions you have here below the video, and we'll try to jump in and answer any questions you have about real estate investing, taxes, whatever's on your mind financially right now. David Lee, good to see you. And good to see all of you. Kelly, Evans, Jay Hill. Nice to see all of you today. Thank you so much, guys, for putting up with the audio issues. Hopefully we've brought you some value, kind of talking about the state of affairs right now in this current marketplace. And we will see you back here real soon.